if you went into the branch versus actually speaking to a mortgage specialist, there's two different sets of rates that they'll quote you. So usually, sometimes when you actually go into the branch, you actually get a higher interest rate.
Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Investing Podcast. This is Phil Wong. With me as always is Brad Price, and back again we have Kim Nguyen. Hey Kim, how's it going?
Good, guys. How are you guys? How's your summer so far?
Pretty good. I don't see you in classes very often.
I know. Yeah. Due to unfortunate circumstances, I do have classes today. But again, different look, right? This is new me, new
It looks
Kim
good.
today.
Does that mean your summer's going really, really well?
I don't know. I'll leave it up to you guys to decide that, good or bad.
Oh, that's good. That's good. Right on. So what are we going to talk about today, Kim? What have you been seeing going on in the mortgage world?
Yeah, so I'll give a bit of a brief market update as per usual. So what we're seeing so far this summer, busy summer. I'm sure you guys have seen it too in the real estate side of things. I don't think anything has slowed down. Us being in Calgary here, the Stampede usually is actually a slow week, but believe it or not, activity is still happening. We're still very, very busy. Lots of sales happening, competing offers. I'm still seeing that's a common thread. So because the market is so busy, same thing as last time, lenders are also still very, very busy. So with now being in the heat of the summer, we're finding that A, heated market, B, being summer, people take vacation. Again, now we're short staffed, right? So we're seeing lender turnaround time still just as slow as it was before. Nothing has really improved. If anything, it's gotten worse because people are leaving for the holidays, right? Mm-hmm. So now we're really short staffed. So my suggestion, again, anyone in the market, just be patient. One of my clients actually, for a refinance deal, like the way that banks are organizing things right now is they're prioritizing purchases. So obviously if you've got a purchase, they will review that first, but again, turnaround time, like expect, 4 business days if you're lucky, but usually it's 4 to 8 business days is what we're looking at. But if you've got a refinance, I just had a client, again, they wanted to go with one particular big bank here, big bank lender, and it took them close to it's 7 weeks now for an approval. 7 weeks for
Wow.
a refinance. Yeah. And this is with one of our big bank lenders. So be prepared. Just know that if it's a refinance, yes, it's a great time to do it because your house prices are up, which I think we've talked about last time, right?
Yeah.
Oh, it's busy, you guys. It's very busy. So just be mindful of that.
So for new purchases, are we still looking at about a possession date you want to put out to around 4 weeks, 4 to 6 weeks?
Yeah, 4 to 6 weeks out. So remember, the 30-day rule is still there, right? There's still some lenders that say, hey, your possession date is before 30 days. No, thank you. We don't want to see this deal. So, either get an extension or go elsewhere. Again, there's still those lenders that can accommodate that. But again, because they know that they can accommodate those time frames, they're charging you more for interest, right? We're seeing that those lenders, they're not the ones that will have the competitive promos. Like they know that they're kind of like the B lender, the B option lender, so they're pricing accordingly.
Okay, so yeah, for those listeners, make sure you have a possession out at least 4 to 6 weeks. Otherwise, you might get charged a bit more for your interest rates.
Exactly.
Let's actually walk through this timeline because I think it's can be a little bit ambiguous for people. So, and also having dealt with this just recently on a couple of different purchases and whatnot, it's very real right now. So when we talk about the possession date, so that's when you write an offer, before we determine the possession date, we need to determine the condition waiver dates. Mm-hmm. So let's just focus on the financing condition for now. We won't worry about the other conditions. But if we're putting in an offer, we're writing an offer right now with a 3 to maybe 4-week condition period for financing, because exactly like you said, Kim, it's taking like 7 to 8 weeks for a refinance. Well, on new purchases, I mean, we've had a couple of deals here where we've had to extend the financing waiver date multiple times for some of the deals because the banks are, look, who knows if they're short-staffed or if they're making mistakes or if there's more documentation required, they're not getting the financing commitments in place, but within a 2-week period, like they were 12 to 18, 24 months ago. So just for people listening, it's very important that you really understand the condition waiver date for your financing needs to be roughly 3 to 4 weeks from the time that you're actually writing the offer. And then on top of that, you need a period of time once your financing is approved for the bank to actually get all of their ducks in a row, have the mortgage instructions sent to your lawyer. Then you got to go through the signing process with your lawyer. And if you're out of town or maybe you're out of province and documents need to be couried, you need to factor in time for that as well. But when you really look at that whole duration, that's what we're talking about, is from the day you write the offer, you got 3 to 4 weeks in there for a financing condition. And then you need a bit of time after that, once you've had the financing approved, to have the legal conveyancing done on the back end of that. So, maybe you need an extra week or two at least in there for the possession date. So you're really looking at a possession of maybe 6 weeks from the time you write your offer. Would that be reasonable to say?
It would be reasonable. And some listening on the podcast here may be like, wow, that's really long. Like, what is the holdup? And the common thing is, most clients don't realize that there is a lot of back and forth, because myself as your broker submitting in the deal to a lender, I can submit it and paint up the business case as best as I can. But if they have questions or they require more documents, I have to go back to you to request it, or if I have it on hand, that's perfect, I'll send it in. But sometimes, though, what many consumers don't know is when I send it back to the lender, your deal has gone back to the bottom of the queue, right? They move on very, very fast. They're like, hey, I need this. And if you don't send it within minutes or something, which is like very, very hard to balance, if you're not sending it within the minute, they got to move on to something else because they've got a long list of deals just that keep adding on and on and on. So just kind of keep that in mind. Like, it's the back and forth with the lenders. Sometimes, again, they really just can't get to your deal until a certain time period. And the unfortunate thing is when they get to it and they need more things, like I said, goes back down to the bottom of the queue. And in between all of that too is if we need an appraisal, which is something we've talked about too, right? Appraisal could definitely delay things. And there's some lenders that will say, you know what, like, I've reviewed everything, but I want you to order an appraisal first before I issue this commitment, because I need to make sure everything's good. And again, with appraisers, they're similar to underwriters and all of us here. During summertime, they also like to take breaks as well. So shortage of staff on that front. So that doesn't really help things either.
Mm-hmm.
Yeah, it's good to know.
So in terms with all this happening, has there been any change in the interest rates recently, Kim?
No, I haven't. So it's funny that you brought it up. There's been some clients who are like, Kim, like, I heard rates are up, like, check this out. Like, it shows that it's much higher now, but that really isn't the case. Interest rates, the real fact, the reality of it is everything has stayed status quo. So, since the last time I was on the podcast here, guys, rates have not changed, right? If anything, there's more promos that have come up, more cashback incentives. We're seeing that become very, very common these days. And we're seeing a lot of lenders extend their cashback promos or just their existing promos. They're prolonging it a little bit more, but really, though, rates have remained the same. I checked bond yields earlier today and it's actually been going down. So again, usually when it goes down for a period of time, which it has been for the past week or so, usually we'll see lenders start to lower their rates. But I think because everything's so busy right now, they're just trying to capitalize on it. So really, if anything, rates are going to stay the same, right? I don't see it going up anytime soon from now till the end of summer. I think everything's going to coast pretty much. But will it go down? It may. There may be some like random pop-up promotions because of how bond yields have fallen. There may be those pop-up ones. And when I say pop-up promotion, I mean some lenders will give like, hey, like we're doing a 48-hour like rate special. Send in your deals during this day and you get an extra 5 points off. Like we may see that. That's kind of my prediction if the bond yields keep trending the way that they are right now. But aside from that, though, status quo is still the same.
Okay. So, I mean, just as a benchmark reference, where would an average 5-year fixed non-insured mortgage sit at this point?
5-year fixed non-insured mortgage. Some of the local credit unions are offering 1.74. So it's
Oh,
still available. Yeah, it's still there. So,
okay.
and we could go even lower than that if you're looking for a really heavily restricted product. But 174 is pretty much like I would say the full bells and whistles of a traditional mortgage, and there's nothing hidden with it. There's no restrictions. That's a pretty much solid interest rate that you could get today.
Okay. So, I mean, I was just on the Canadian Mortgage app earlier today, and I'm looking through the interest rates, and then I'm seeing in the low twos, low to mid 2% ranges for some of the for the 5-year fixed, interest rates. So, I mean, if things haven't changed, like how come those rates are higher, versus what you actually get at an actual bank?
You gotta be careful because I always warn my clients. I'm like, when you're fishing around for rates online, sometimes you gotta keep in mind that it may not be up to date, right? Or sometimes it could be like an older rate that's no longer available or promotions or something like that. So you gotta be really careful with that. I think with the app that you're looking at too, just kind of keep in mind, especially if it's with a major bank. Coming from working at a major bank, the way that it operates is there's always a discount rate that certain mortgage brokers or mortgage specialists can provide to you, right? It's always a discount from the posted rate. That's what your actual interest rate is. And the stuff that you may see online may be the non-discounted rate. So just be careful of that. So that's why sometimes it may seem a little bit higher, but be careful though, right? If you go into a branch where, and this happened a lot too when I worked at the bank, if you went into the branch versus actually speaking to a mortgage specialist, there's two different sets of rates that they'll quote you.
Hmm.
So sometimes when you actually go into the branch, you actually get a higher interest rate.
Why is
So
that?
I think because of pricing, again, like the bank that I worked at anyways, is that the pricing was relatively similar, but then at the branch, like their main focus wasn't really mortgages per se, right? They had like a target rate that you should give to clients. And if your client's being picky, then, you could give them a little bit of a discount, but obviously you need to get approval for that. And then like, if this is a really high net worth client, then you could go down to the floor rate, right? But they always give you a target rate, and that's usually the rate that you have to sell. And sometimes the target rate on the branch level versus the mortgage specialist is two completely different ones, because a mortgage specialist, their job is to get mortgages day in and day out. Like that's their that's their goal, right? That's their occupation. Whereas a branch staff, their main focus is, if you come to them for a mortgage, that's great, they can help you out. But really though, they're more holistic. They want your investments, they want your checkings account, they want to help you with your Visa credit cards, all of that stuff. Whereas the mortgage specialist, in order for them to be hunters and gatherers of bringing new business to the bank, sometimes they need to have a better target rate, like a lower rate that they can offer clients to kind of bring clientele into the bank.
Okay. So the non-discounted rates that you see online on various apps, when would a person not get the discounted rate and are stuck with the posted rate? Or does that ever happen?
You know what? No, it doesn't really happen. And what I've seen too is that you got to be really careful with what you see online, because sometimes the higher rates, if you bring that up, and I know this too from working at banks, like just seeing it, like if a client would bring in a higher rate and be like, hey, like I saw this rate online, it's 3.5%. When you and I, we all know right now rates are in like the ones, the low twos and stuff. If a client actually brought it in and was like, hey, I want 3.5, your branch staff most likely would oblige to be like, yeah, okay, I can get you at 3.5%. Like, I hate to break it, but sometimes that's the reality of it. That's why you have to really do your shopping. You have to, like I said, you can't just go to one place. You have to shop around, right? This is a mortgage that we're talking about.
Yeah, totally. And that highlights a rule of negotiation too. Never be the first one to state the price.
Ever. Exactly. You have to do your research.
So one thing you said a little earlier here, Kim, was about restrictions and bells and whistles.
Mhm.
So can you just explain what that means between product types? Obviously, you might be able to get a stellar interest rate, but you might end up with restrictions
Mhm.
versus a mortgage that comes with all the bells and whistles. So what's the difference?
Yeah, so I mean, when I say bells and whistles, I'm talking about the standard items like being able to do lump sum payments, right? Being able to do payment increases, being able to port your mortgage, right? And be able to have reasonable port terms. So porting just means like if, let's say, during the term you decide to sell your home. So let's say a client gets like a 5-year fixed mortgage, and let's say year two, they're like, oh, like I hate my neighbors, I just want to move to a bigger, better home. Because you sign on to a 5-year term, usually there's a penalty that's applicable, right? If you do any type of changes, you discharge your mortgage, there's a penalty. The only way to save that penalty is if you transfer that existing mortgage and move it into the new place. You sell your existing home, but you take that mortgage to the new place. As long as the mortgage balance is equal to or greater than, in most cases, you actually get your penalty back. But when I say full bells and whistles, sometimes those options that I mentioned there aren't available. And what actually happens is a lender will say, you know what, Brad, like Phil, we're going to give you this really cheap, dirty, low rate, but in return, like we're going to strip you of all your privileges, right? You're not going to have all the options, like all of the features. You're going to be limited. So a client who's really actively, the example I like to use is lump sum payments, right? We know that that can be such a game changer in paying down your mortgage very fast, right? It's a huge game changer, especially if you have the ability to throw on extra money towards your mortgage. It can shave off years off of your amortization. Well, some lenders will give an extremely low lump sum pay down option. And in cases like that, where you're someone who, aggressively wants to pay down your mortgage, maybe that doesn't make sense. Yes, they'll give you a really low interest rate, but the overall scheme of things, if you really want to pay down your mortgage, maybe it's not worth that low interest rate, but finding a lender that maybe the rate is a little bit higher, but it gives you that privilege to pay down your mortgage faster.
Yeah, makes sense. Makes sense for sure. And I think it's like you say, it's really important to determine that ahead of time so
Mhm.
that you don't get halfway through a term and then realize, oh, I actually don't have the option to maybe pay this mortgage off quicker or I'll port it to another property. That leads me to another question, actually, just with the porting
Mhm.
process. Maybe if you want to dive into the details of how that porting process works and the timelines that you need to, sell your property within to kind of move that mortgage over. I know in the area contract, there is actually a condition there subject to sale of
Yeah.
your existing property. So I'm assuming that term would be required to be used in this instance. But
I see. Yeah.
when it comes to porting mortgages, does it also apply in the same manner for rental property mortgages?
It does. Yeah, it does.
Mm.
You can port a rental property as well too. It's just the only thing that you have to be mindful of is every lender has different porting rules, right? Some of them will allow you 90 days to port. Some of them will allow you 120 days. We've even seen some that were even as low as 30 days, which is really highly unrealistic, right? It's
Mm.
really hard to sell a home and find another home in 30 days, right? And to be able to close. When I say like 30, 60, 90, 120 days, the way that like what I'm mentioning is that you need to be able to close on the new home within that time period. So if the lender's policy says that you have a 90-day port policy, that means you've got 90 days from the day that you sell your existing home to find a new home. That means take possession and everything. So if it's 30 days, you can imagine it's kind of tight, right? It's kind of unrealistic, to be honest with you. That's why, again, it's all about the details. You got to ask.
Yeah. And is there any form of application process that you've got to go through again with the port process?
Yes, you do. And such a great question because Brad, I get asked this all the time where clients are like, but I got qualified already. Like I'm just moving my mortgage. It's like literally the same amount, dollar for dollar. Why do I have to requalify? And the reason is because rules change, right? Maybe 4 years ago when you did your mortgage, there wasn't a stress test or the stress test was different back then. So anytime that you do decide to port your mortgage, always remember it's requalification. So never, ever, ever sell your home without actually getting requalified to make sure that you can actually qualify for a new home. So I've seen that that is a common mistake. I actually do see it quite a bit. Clients will sell their home. They're like, oh, don't worry, I'll just port it. But they forget that, oh, I still do need to qualify. They're all wrapped out about the penalty. But yeah, it's a full blown application process.
So it could really leave a lot of sellers in a pickle, eh?
Yeah.
It could be homeless for
Oh my gosh, yeah. For some time,
a
but then
short period. Yeah.
yeah, but then that's why even for us as investors, that could mean opportunity for us too, right? Agreement for sales or rent to own short term, like just some type of creative financing to kind of help those in a pinch. So another rabbit hole to go down. Mm.
Yeah. Sorry, go ahead, Phil.
No, I'm just curious, like in terms of rates, I know that a lot of things affect the type of interest rates you get, because there's always a poster rate and the discount rate, as you mentioned. But what affects the level of discount that a person will get depending on their circumstances, like whether they have a credit score or down payments or stuff like that?
Mhm. So I always like to break it down to a few different components. So number one, credit scores do matter. When it comes to interest rates, believe it or not, it does matter, right? Not with all lenders, but with the majority of them. And some of them have even gone down to the point where they say, if your credit score is within X range to X range, you're going to get this kind of interest rate. If it's between this range to this range, this is your interest rate. And usually we find that if your score is above 730, you'll always be in the higher range, right? That's going to be deemed as like a good credit score to have the absolute best interest rate. So if you're wondering about that, 730 is the number that you want to keep in mind. Again, it's not applicable to all lenders, but there are some that kind of grade you in that sense. So credit score is one. The other one would also be your down payment. So as long as the way that the market is right now, if you are getting an insured mortgage, meaning your down payment is less than 20% and you're paying an insurer premium, you're going to get the best interest rates. It sounds completely twisted. I know so many of my clients are like, you're telling me, Kim, if I do 5% down versus 20% down, I'm going to get a better interest rate, even though I'm putting less money in and it's kind of risky. And the answer is, yeah, it is, because the mortgage is insured. The banks, the lenders, they have absolutely no risk, because if something happens, they're going to get paid out by the insurers anyways. And again, like, their hands are clean. And that's why they're able to give those types of discounts out. Whereas if it's 20% or more, like a conventional deal, your interest rate will be higher, guaranteed. And usually the range can be anywhere from 10 basis points to 15. Sometimes I've seen it as high as 20%. But again, too, it varies, right? Sometimes there's also promos that offset it. And then those promos will make everything equal, right? From one lender to another. But insured rates, though, for sure, they're the lowest, guaranteed.
Mhm. And how about down payment? I guess what I'm trying to ask is, if you have a higher than 20% down payment, so if you lower the risk for the lender by having more down payment, does that change your interest rate?
It does, yes, because now we step into this new territory called insurable mortgages. So
Okay.
it's very confusing. So I'll tell you, like, in my world, there's basically three buckets of where you can be. It's either you're an insured mortgage where your down payment is less than 20%, you're paying a premium. There's a conventional bucket, which is your down payment is 20% or greater. But there's also kind of like a middle bucket, which is the insurable bucket. And this bucket here is where you're doing more than 20% down payment. And as long as the mortgage is insurable, so what would happen is a lender would back end insure it, which means you as a consumer, you don't pay any type of premium. The lender actually pays a premium on your behalf. But because the mortgage is back end insured, they can actually give you better interest rates because of that. But the downside, though, when you're looking at insurable mortgages, is that, again, it goes in tranches, right? Like, if you're doing 20%, you'll get a certain interest rate. If you're doing 25%, you're doing, you get another type of interest rate, and it actually goes lower. So if you actually get up to the 35% down payment mark, your interest rate is almost on par with what it is insured, right? It's kind of strange, but But when we're looking at the insured bucket, though, the one thing that most clients need to remember is that it's only available on primary residence. So rental properties are not back-end insurable. And on top of that, too, the amortization maximum is 25 years. So if you need a 30-year to qualify, or you just need it for cash flow purposes, you're automatically in the uninsured bucket, right? You're the uninsured conventional bucket. And again, those are usually the higher interest rates there. Like, just always remember, if it's 30 years, just know that you're going to get the higher interest rate.
So if you're buying a primary residence and so you have 20% or more or down payment, is it do you have to ask for an insurable mortgage, or is it something that just happens?
It happens. So if you're working with, so here's another thing. If you're going directly with your banks, most banks don't have insurable rates. They either
Hmm.
have an insured rate or a conventional rate. There is no in between. But when you're working with a mortgage broker, we have access to monoline lenders, which we've talked about. Monoline lenders are lenders that only deal with mortgages only. And with monoline lenders, they're the ones that have that access to the nice insurable rates. So you'll only be able to get the insurable rates if you're working with an actual broker.
Oh, that's good to know.
Interesting. So when we're talking about down payment amount, amortization, insured versus uninsured, is there a sweet spot? Is there like the perfect recipe to get the
Like the
best interest
best
rate
deal.
with the least amount of money possible? Like, what have you noticed?
Are you asking about rental properties, Brad, or are you talking primary
Well,
residence here?
let's do both here.
Okay.
Both. Well, unfortunately, when it comes to a rental property, there, we need that 20% minimum. Again, and most real estate investors need the 30-year amortization for cash flow purposes, right? So automatically, like, you're in that tier where your pricing can't get that. That's basically, I like to say that's the worst pricing, to be honest with you, right? Like, if you're buying a rental and you're requesting it for a 30-year amortization, you basically have the worst rates because it's a high risk product and you're asking for that longer amortization. To kind of maybe make it a little bit better, you could ask for a 25-year amortization instead. And some lenders will acknowledge that. And some lenders will be like, okay, you know what, Brad, Phil, you guys are buying a rental and you're asking for 25. You know what? We'll knock off a few points off of your interest rate because of that, right? There's few lenders that will do it, but most of the time, though, it's not even worth it, in my opinion, because for a rental property, the reason why we want that 30 years is we need that cash flow because it's going to help you out in the long run, right? There's no point in doing 25 unless you absolutely need to, or unless it still cash flows strongly. But in most cases, 30 is the way to go, right? So rental wise, not so much. When it comes to primary residence, though, the sweet spot is really having an insured mortgage. And if you can do 15% down, number one,
Insurable mortgage, you mean, yeah?
or insured. Like, if you're looking for the best deal,
Okay, so
insured,
under
yeah.
20%. Okay.
Under 20%, yeah.
Okay.
And what I would do is I wouldn't stick with the 5%. I would stick with like a mid number, like 15%, because then you're not paying so much insurer premium, right? Especially, like, that's only if you have the 15%, right?
Mhm.
Then you're kind of getting that low interest rate, again, because it's insured. So that would be the best case scenario. But then one thing I always recommend too is, don't sell yourself short. This is only if we were comparing just one lender. Like, if you were to go to a bank lender, then yeah, this is going to be the best case. But if you're working with like a broker that deals with multiple lenders, if you have 20% down, they do have the ability to shop around at other lenders to kind of compare and contrast. And let's say if we were dealing with just one bank, like let's say TD as an example, right? Their insured rate, let's just say it's 1.45 and their uninsured rate is 1.55. Well, I'm pretty sure that if you're working with a broker, they could probably find you an uninsured lender that is going to give you 1.45. So the same rate that TD is offering you on an uninsured product, right? Because there's always promos that come and go. So again, it goes back to shopping. Don't sell yourself short. There's tons of promos out there.
And really, I mean, if you look at it that way too, the 10 basis points, is it really worth paying that premium?
That's true. Yeah,
Right.
that's true. Yeah. Could be another thing. Like, if the spread was a little bit bigger, like at one point in time, the spread was about 20, right?
Mhm.
But now that it's so close, and most likely you can find another lender that's offering the same, giving you a conventional rate or a conventional mortgage with insured rates, Well, there you go. It's a win-win scenario for you. This is the time to do it because again, promos are coming. There's always a promo live. In the mortgage brokers world, there's always promos.
Hmm. And I mean, back to the 5 to 20% down payment. I mean, if you look at 5%, I don't know if a lot of people know this, but because the insurance rate is like what 4.5% on a 5% mortgage, right?
4%, yeah. The
Yeah,
insurance premium's 4%. It's hefty.
4%.
It's hefty, yeah.
So then at the end of the day, even for the 5% down payment, your equity position is only a 1%.
Exactly. Yeah. Yep. A high risk mortgage, right? It's a high ratio mortgage. Yeah.
So the price drops for 1%, you're already underwater.
Yeah. So, and that's why, like, sometimes too, there's other reasons why some clients may do a 5%. And especially because interest rates are so low, maybe it does make sense to just, bite the bullet, do 5%, pay that insurer premium. But if you have other money and you know that you can make a super large return, maybe you're going to invest in a bunch of stocks or something and make a killing out of it, then yeah, maybe it makes sense. Maybe you can balance it out. But if you have that extra money and it's just going to sit in like a checkings account earning 0.000% interest rate, then like that does not make any financial sense. It's better that you dunk all that money into your mortgage, save on the insurer premium, save on your overall cost of your mortgage.
So, Kim, one thing that I think we should clarify here, as you mentioned, Phil, the less amount of money that you do put down, the higher the insurance cost is for you, which means that you end up with next to no equity and you buy. But what's the range, Kim? What's that interest percentage range on the difference between a 5% down payment and maybe an 18% or 15% down payment?
Oh, right now, guys, like it's nominal, like under 10, right? 10 at the most. Like it's very, very little right now, anyways, as it stands.
10 basis points, you mean?
Yeah, 10 basis points. Yeah.
Okay.
Yeah. Okay. No, that makes sense. And then, so just if we go back to what affects your discount, how about, you tick a lot of the boxes, no problem. You got good credit, type of property is fine, amortization is what it is. What about your portfolio? What about stuff that you already own? Or maybe you've got, I don't know, other lines of credit or debts or whatever. You might have a good credit score, but what about those other things? Do they affect the interest rate that you get from a risk perspective?
You know what? Surprisingly, no, it doesn't. So
Wow.
as long, yeah, so as like even if you have a ton of debt or whatnot, your interest rate is your interest rate, right? If you're paying it on time and your score isn't affected by it, you're still going to get the best rates. It's just the only thing is that if you have a lot of debt, it may affect how much you can qualify for, right? That's the downside of it. But when it comes to pricing, no effect.
Okay. So I'm guessing on the other side, if you have a ton of assets, also, would that affect your interest rates at all as well?
Does not affect. And
Okay.
again, a lot of people think that too. They're like, but my net worth is so high, like X, Y, and Z. Unfortunately, it used to be a thing of the past, but now not so much. If you've got a lot of assets, banks will say, they'll look at it and be like, great, you're low risk. That's it. And like I said, they just move on from it, right? It's you're low risk. Okay, great. Moving on.
So, Kim, what is the best interest rate that you have seen very recently?
So
What's the best you've seen?
yeah, so the best I've seen. So again, like I'm all about full featured, full whistles, like everything, right? Like that's kind of what I look for because to be honest with you, my personal opinion is I personally don't believe in selling those products that are restrictive. I don't believe in restrictive mortgages because life is variable, right? You never know what can happen. You may have plans for a home that you say, yeah, I'm going to keep this for 10 years, but you can't predict the future, right? A lot of things happen, especially with the pandemic. Like we've seen, a lot of situations go sideways, separations, growth of family, expanding a family, like all of those things are variable. You can't predict it. You can't control it. So for like a fully featured, full bells and whistles mortgage, the best I've seen right now on the market, the lowest would be 1.29%, and that's for a 5-year. And that's also with the 30-year amortization too. So it's available for that if you're doing 20% down or more. And then in terms of rentals, 1.49. So again,
Wow.
both like variable rates. Obviously, with the fixed rates a little bit higher than that, so pretty much add like about 60 basis points on top of what it was quoted. But right now, I'm still a fan of the variable. Right, life is variable, so your mortgage should be too. That's kind of been my motto. So.
That's a good way to look at it for sure.
Yeah.
Awesome. Well, I'll give you last word, Kim. Is there anything we missed when it comes to interest rates on mortgages?
I think, the one piece of advice that I always tell my clients is, shop, right? Just don't think that walking into your branch, you're going to get the best deal because you've got all this stuff with them. You've got a checkings account, you've got overdraft, you've got visas. Like, don't think that that's going to give you a better rate, right? You got to compare and contrast. And speaking to what Phil said, you never give a price first. See what they can offer you and then kind of do your own research. Just don't take the time to do it. Like, take the time to invest in this stuff. Like, don't make a rush decision, make an educated decision. That's all I can really say.
Okay. And I guess the best decision for that would be to touch base with a mortgage broker as well. Yeah.
Yes, exactly.
So they can do the shopping for you instead of having to hit every bank and take a huge hit on your credit score
Yes.
as they pull your credit every time.
Yep. Try not to do that. Yeah,
Yeah.
that's not a good thing either.
And don't trust what you see online.
Yeah.
All right.
I think that goes for a lot of things.
If it seems too good to be true, it might be. So
All see on life. Don't trust what you see online.
yeah, like a life lesson podcast now.
Awesome.
All right, Kim. Well, thank you. Thank you again for another session, and hope to see you again soon.
Thanks, guys.
Yeah. Have a good night.
Thanks again.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, remember to get out there, take action, and create a life of wealth by design.